Welcome to the What to Watch video update. This is the last video I do over the weekend where I look at all the charts that I've used throughout the week and I pull out those and I put them into three categories. Those that are positive, those that are negative, and those things that I'm just keeping an eye on because they can have an impact on the market. Then I put them together into this video. And this changes every day, but I still just do this video once a week. If you're interested in looking at updates for this video, I do a video every day that you're more than welcome to watch. This is being prepared for Monday, March 17th. The first are the things that are positive. Now, the list is kind of short this week. We've been really going down, but there are some positive things that we can keep an eye on here. And like with most of the charts, whether they're positive or negative, we can see positive things in the charts, but we can also pick out some negative things at the same time. The first chart is the advanced decline line. This has actually been holding up quite well, both based on price and volume. It's above an advancing moving average, and we did tick up on Friday. Now, even when we've been going down with the S&P, the advanced decline line's been holding up fairly well. Now we're seeing a little bit more of a dive here with the volume because that's the mega caps. People are selling that, and that accounts for more volume, and that has more of an impact on the volume calculation. That's the positive side in that we're holding up okay. The negative side is that we're not seeing money coming out of the market. We're seeing it rotating from offense or growth to defense, which is value. Now, we could be seeing some signs that things are starting to switch back, but we've seen these signs before over the last few weeks, and they've led to nothing. Will this time end up being a little bit different? So that's really why the advanced decline line has been holding up, because it's going from one area of the S&P to another area of the S&P. One area is coming down that has more volume, so we see a drop off here. The other area might have less volume, but it's holding up as far as price is concerned. Then we look at accumulation distribution. Now, if you've watched any of the videos recently that I've done, I usually have another indicator attached to this, but it's so far off of what we're trying to look at here. I'm actually going to stop using that indicator for a while. This measures the smart money, and this is smart money indicator number one. This is still positive. Even though we've been coming down with the S&P, we've been able to maintain above this moving average because this is calculated not only on price, but also on volume. So that means some buying is going on inside of the S&P. Now, after Thursday, we dropped a little bit down below this red line to turn this negative, but then with Friday's bounce, we came back above the red line. So this has been holding up, but it's not necessarily telling us the whole story because other charts that we look at are showing this rotation going on, where if you just look at this all by itself, it looks like, well, everything's fine. I should just wait for the market to go up. But it was looking fine going into the latter part of February and all the way so far into March. And you would have been buying, 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 buying as we were going down, down, down. So we need other charts to help give us some positive confirmation. Then another one that's turning back a little bit more positive. This is the Swanland Trading Oscillator. It had been declining based on price and volume, actually kind of going sideways here based on volume. But after Friday's bounce, we're ever so slightly turning up based on price and volume, but we're still below zero. But sometimes this can give us a good heads up that maybe we're turning a little more positive. But there have been times lately when this led us astray as well. It looked like this chart was showing an improvement could be happening only to see things turn and continue to go down. This is smart money indicator number three. I'll get to smart money number two here in just a moment. This is the Chaikin oscillator. And we usually determine if this is positive or negative by the direction. And then it's a little hard to see, but I have a short-term moving average on here as well. When we're going up, that's positive. That means the smart money is buying. When we're going down, that's negative. That means the smart money is selling. And we've been really choppy lately. And we are turning up a little bit here after Friday's bounce that we saw. So we have two out of our three smart money indicators that are positive. Unfortunately, the third one I'll talk about when I get to the negative side. Yeah, looking at the long-term trend of the S&P, yeah, we've been getting hit here, coming down, but we're still well above this long-term trend line going all the way back to the 1987 crash. And we look at a ratio between the QQQs, which is the NASDAQ 100, and the IWM, which are small caps. If we were really falling apart, we would see a real deterioration like we saw during the dot-com bust back in 2000 into 2001. We're not seeing that now. This ratio is actually holding up. Small caps have been under a lot of pressure, and that's what's been helping to keep this ratio higher. And it's not that the QQQs have been doing well, they've just been doing better than the small caps currently. So we're above this blue line. And for right now, that can be treated as positive. Then we look at another ratio of growth versus value, the NASDAQ 100 to the Dow. Now, there are some tech stocks like Nvidia, Microsoft that are in the Dow right now. And even though everything's been getting hit, we're seeing this ratio still holding up above this red line. That's positive for now. This to me is the big one. Now, you could treat this as negative because we've been going down, but as of Friday, we were able to turn this back a little bit more positive. This is a weekly chart of the S&P, and these are pivot points, and they're plotted. They last for the whole quarter. In fact, at the end of March, we're going to be getting a new set that will be coming out here. And these can be very significant long-term support or resistance levels. Just to give you an idea, when we were really going up in 2021, we hit one of these pivot points at that time. And then we went into 2022, and that was a bear market, a cyclical bear market. Then when we were coming up out of that in 2023, we hit this pivot point again. And this is when we had a pretty significant decline after that. But then we turned and we're able to break above it. We came up here into 2024, and this was the end of the world day. This is last August when everything was falling apart. We hit this pivot point and then bounced up out of that. Now, we're actually falling a little bit below this pivot point currently, and that could be negative because you see a lot of the other examples that I pointed to. We hit this level and turned right at that point. We haven't turned right at this pivot point for now. Now, for a lot of the week, we were below this pivot point, but with the upward move that we saw on Friday, we were able to get back above this pivot point for now. So I'm still treating it as positive. This is very long term, and we do sometimes see where we could bounce up out of this and actually see things turn more positive. But we're going to need to see more than just this. But this is long term, and for right now, this support level is holding. Now, that's the whole positive side for right now. We have quite a list of things on the negative side. The intraday chart, the reason this is on the negative side, we had an up day on Friday, but we were down for the week. And you can see we gapped lower on Monday and just went down, saw a little bit of buying going into the close. Tuesday, we saw some late day buying that showed some promise, but then we closed off of the high. We saw some early day buying here, but it was probably too early in the day. Then we ended up seeing some late day selling. These are things that I watch for. This is why I watch an intraday chart, and I use a 10-minute candlestick chart here. Then on Thursday, we just picked up where we left off on Wednesday. We just kept going down, 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 down. This is when we really started to test that long-term support and actually break a little bit below it. We held up over here. We're also breaking down below the 200-day moving average for the S&P. Well, we did see a little bit of buying coming into the close, but that didn't really last. We ended up closing pretty much at the low for that day. Then Friday, the futures were positive before the market opened. We had consumer sentiment come out, which was not a really great report, but still the market was able to gap higher, hold on to those gains without filling the gap. We made it all the way up to S2 and we kind of stalled out there, but then right at the close, we did see a little bit of a bump up and we closed at the intraday high. This is what we're wondering right now. Is this some kind of a reversal? We don't know that yet. You could suggest that, okay, we're hitting long-term support. We're very oversold. We worked off a lot of the oversold condition in Friday's session. Could we continue to go up from here? Of course we could, but we don't know that is actually what's going to happen. Then looking at the daily chart, we're quite negative here. We fell down below the red line, which is the 200-day moving average. Now, one thing that's kind of negative, and I'll point this out in some other charts later on, we bounced up on Friday on below average volume, and that's a bit of a concern. As we've been coming down here, we've been above average with volume the whole way. And then to see a little bit of a bounce and to see volume taper off, that's a warning sign. But at the same time, in Friday's session, most of the volume that did happen, 90% of it was to buy. That was up volume. And sometimes big moves start that way. Okay, then let's see, I hit the wrong button here. Okay, then looking at the new highs and new lows, we're seeing a deterioration here, where for much of 2023 into 2024, we saw a lot more green than red. Well, now we're seeing a lot more red lately than green, and that's causing our 5-day and our 10-day charts to go down. And we're seeing kind of an expansion of the new lows overall and a real contraction of the new highs. And that's internally, and that just suggests there is some weakness that's building. Also, another way that we measure this are the advancers minus decliners over a 10-day period of time. Now, the advanced decline line itself is looking okay. This is an oscillator over 10 periods that's derived from the advanced decline line. And when we're below zero, we're negative. When we're above zero, that's positive. We use this like an oscillator. We look for positive, extreme positive or negative readings. We ticked up barely we were up 2%, over 2% on Friday. And this barely just nudged back up. So that's a bit of a warning sign. Plus, this chart is already negative since it's below zero and for the most part has been declining. Then we look at the short-term trend, and I use a thing called the ADX, and that just measures the condition of the trend, not necessarily the direction of the trend. We get that from other lines that we see on this chart. We've been going up above the moving average, and I put the moving average on here. Now we're a little extreme right now because the ADX is above 40. That's usually where we really start to go, maybe this is going up a little too fast. Now we could go way higher than that, like we did last June into July. So it doesn't mean we have to stop here. We just watch this a little more closely. But this is a strengthening trend because we're above the moving average and we're above this blue line, which is 20, and that's a confirmed trend. Now, where we get the positive or negative from is we see the red line is above the green line. That's why it's negative. So if we are rolling over just a little bit here, we're not seeing that on the other charts, but we're seeing it a bit here. We're seeing the red line kind of coming down a little bit and the green line coming up. If that continues, if we continue to go up, we might see this start to change, but that's only speculation at this point. This is the intermediate term trend and the chart that I focus on the most. We're also above 20 with the ADX, above the moving average. The red line's on top, even though it's coming down, and the green line's on bottom, even though it's coming up. But this is a confirmed intermediate term negative trend. Then every week, I do a weekly video as well that you're more than welcome to check out. I post them both on YouTube and Rumble. And we're just starting a trend here. We're not above 20 right now, so it's not a confirmed trend, but we have crossed above the moving average. Well, unfortunately, this is a negative trend. The red line's going up, the green line's going down. So longer term, we're starting to turn more negative as well. Then we look at the condition of the short-term trend, and my definition is 20 periods. And we have a double and triple exponential moving average here. They move very fast. And we're going down with both the green line and the blue line, and price, for the most part, has been setting a series of lower highs and lower lows. The only exception was Friday, where we actually broke out a little bit here. If we can see that continue to go up, this will help improve this chart, but for right now, it's clearly negative. This is the condition of the intermediate term trend based on 50 periods, and we're seeing pretty much the same thing. Going down with price, the red line and the blue line going down, a little bit of a bounce on Friday, but we didn't even get back up to these lines yet. All the moving averages that I plot here based on 20, 50, 100, and 200, prices below all of them. And we're starting to see this kind of waterfall look with these shorter term moving averages. That's negative. But we're far away from the 20 period moving average, 50 period moving average. This is used like an oscillator. We're getting too far away from both of those moving averages. And when we do get too far away, we have a tendency to bounce back. So if we do see a continuation of the up move on Friday, what we're going to be watching for is, are we seeing a general shift in the overall climate from negative back over to positive? Or is this just a bounce to try to get us back in line with some of these moving averages and some of the other indicators that we look at? And then once we get done doing that, we're going to turn and go down Again, we don't know that at this point. That's what we're going to be watching for. Then these are anchored moving averages, which are a little bit different than regular moving averages. They project forward. And a week ago, when I did this video, we were watching this light blue line saying, can we hold on to that? Nope, we didn't. Now, unfortunately, if we do start to go back up, what was once support now may become resistance. So we've got a lot of these lines right here that we have to break our way through that could be acting as overhead resistance. That's if we go up. If we go down, we have a purple line here, which this goes to the low set back in October 2023. That was a significant low. And if we come down here, will this level hold? We've been working off of the trend both from the October 2022 low and from the October 2023 low. If we lose this October 2023 low going forward, that could turn things a lot more negative, and now we might head down to this next line after that. So these are just some of the things that we want to keep an eye on here. And then this is a newer chart. If you haven't watched, or if you have watched these videos before, you probably haven't seen this. This is just another way of measuring what's the trend doing. It's called the bow tie. And the green line is a 10-period simple moving average. And then we have a 20-period and a 30-period exponential moving average. And this works similar to a rainbow. When the green is above the red and above the blue, that's positive. Right now, we see the green is below the red and the blue, so that's more negative. Then we keep an eye on what are the percentages, because we went into correction territory with the S&P this week, but then we came out of it on Friday. Now, I measure things a little bit different. Usually, it's measured on a closing basis. If we go from the all-time high, which was set on February 19th, and then the close that was set on Thursday, March 13th, yeah, we were down 10% at that point. I measure it from the intraday high to the intraday low. And according to that, we were down almost 10.5%. I put these on here, and if I move it just a little bit, the whole percentage changes a lot. So it's not an exact science here. If the smart money is going to make a stand right about where we're at now is where they're going to have to do it if they want to turn things back more positive. Now, we did bounce up on Friday, so that took us out of this correction territory, even on a closing basis. So if we continue to go down and we fall below this 10% level, that means we're in a correction. Then this is the percent from the closing high. This is where we came down almost, or we got up here. This actually goes a little inverse to logic as the S&P has been going down. This is measuring how far away we are from that all-time high. And we hit the 10% point, and now we've been bouncing down as a percentage. And we're wondering, can we bounce up out of that? Now, we saw something kind of similar last summer in August. We came down, we didn't quite get to the 10% level, but we were close. We were at about 9.5 or so on an intraday basis. And at that point, that's when the smart money decided to come in and start buying, and that pushed this up out of it and turned things back more positive. But be aware, the context of what was happening last summer and the context of what's happening right now are different. We've got a new administration. We've got the tariff concerns. We've got a trade war with Canada and probably with Mexico and possibly with Europe. We've got all these things going on with these cuts happening at the federal level. And it's happening so fast that a lot of people are having a really difficult time keeping up with what's going on, including the stock market, because you try to latch onto something major and then a little while later, something else major is happening. And so when in doubt, the market tends to sell. These could be long-term positive things for the market, but the market doesn't know that yet. And they're confused about things. And that's why we've been seeing a lot of pressure going back to about the middle of February. Okay, then this is one of the things I wanted to point out. We've been above average with volume here. That's when we see the histogram green. But in Friday's session, when we went up, we actually dropped below average with volume. That's a warning sign. That's a classic technical analysis 101 warning sign, a negative divergence, going up with price and down with volume. Then another thing that's been really strange is I really put a real big emphasis on sentiment. How are market participants feeling about things? When they're positive, this line goes up. When they're negative, this line goes down. But usually we get to a point of like critical mass where everybody's happy. There's nobody left to be happy. So then we turn and start going down as far as the market is concerned. And usually when everybody's pessimistic, we come down and drop below this 25 level, or at least get near to it. And we tend that tends to be like a short-term washout. Like everybody's like, this market's never going up again. I'm just selling just to get out. I don't care what price I get in. Just get me out of the market. That's all I care about. And that produces some of these V bounces that we see. This time it's different because we're coming down and we drop below this 25 area and we're camped right here. We've been camped here for quite some time, and that's unusual. But usually when we're down below 25, that's when we consider using this as a contrarian indicator. Everybody's pessimistic, so we're looking at the possibility of becoming positive about things. And we have some positive things we can latch onto, but we need confirmation that things are actually turning back and looking positive. Another thing that is negative right now, but could end up being positive, investors' intelligence. This is a weekly survey of all the people out there that give recommendations. Buy this, buy that, sell this, sell that. Well, when they take all the people that are in this survey together, they're getting extreme negative. They're under one with the latest reading, coming in at 0.8. And a lot of times, when all these people are making recommendations and they're all negative at the same time, that can often mean that we're at a bottom. So we'll have to see. Is this going to actually end up meaning something? Then we're also looking more negative here when we look at the bond market. What this chart does is it measures the spread between risky bonds, like junk bonds, and not risky bonds, like government bonds. And when this starts going up, that means fear is increasing. Now, in the next chart, what I've done is I've inverted it. Actually, David Keller from stockcharts.com created this chart. I just reproduced it and show it here just to match up with what's actually going on with the price of the S&P. And it's been coming down. Well, you can see this has been coming down, which means fear is going up. And then down here as well is an inverted version of the VIX. This has been going down. That means fear has been going up in the stock market. This is a little bit of a concern. Now, this is the bond market, and we deal with the stock market, but still, they all interact with each other. And I do an intermarket analysis video every weekend to try to show the relationships between the different markets. But if this continues to fall, that's going to be more negative. Then this also measures how are people feeling. This is the VIX. When it's going up, people are fearful, and this is coming down, which it did come down in Friday's session, but we're still above the 20 level. When we get above 20, that's where it's negative on an annualized basis. To have this turn more positive, we're going to need to drop back down below 20. And up here, I have the line chart, which is the closing value. And down here is a bar chart, which is the open, high, low, and close. And the momentum of the VIX, where it's been going up. As the S&P has been coming down, the VIX has been going up. We could be starting to see a change. It hasn't happened yet, but the momentum is actually starting to shift. And that could end up being positive for the market. And then for 3 weeks in a row, you have individual investors who have been negative 3 times. Usually what we see is they get really extreme negative, and that produces a climactic event or a washout, and then the market bounces up out of that. Well, for 3 weeks now, we've been down here, and this moving average has been coming down. And this is kind of lining up with what we're seeing with the other sentiment gauge, that we're just coming down, getting extreme negative and staying that way. And we are looking at potentially some improvement here, but it's still negative overall. This is an intraday chart of growth versus value. The blue line is growth, and when it's going down below the red line, that means value is outperforming, even if it's going down. The red line is value. Even though they're on different scales, we want the blue line to be above the red line. Now, there's a little bit of hope here because we are starting to go back up a little bit. We need to see the blue line continue to go up and actually go above the red line and then keep going up after that. That would help things turn more positive, similar to what we saw back in early January, where we saw a reversal of that, where the red line was underneath, but then the blue line really just shot up here and it was looking more positive. Then about the middle of February, that's when things started to really fall apart. And that's what we're seeing right now is that value's been outperforming growth. Then we look at the growth to value ratio intraday for the S&P. This has been showing a little bit of an improvement here. Not great, but it's improving. But overall, about the middle of February, we really started to come down. So overall, The trend is negative here, but it might be showing some signs of improvement. But we've seen signs of improvement before that I tried to point out, and then it turned into more declines after that. This is smart money indicator number two. I have three of them. We saw the first and the third one on the positive side. This is negative. This is the Chaikin money flow. And we're coming down with the histogram. We're actually turning negative. It's actually starting to turn red now, and the red line's going down. So this is negative. The vortex, another primary indicator, it's negative because the red line's above the green line. Late earlier in the week, what I was trying to point out is maybe we had gone extreme negative here with the buyers. That's what the green line tries to measure. Well, we're coming up out of that a little bit, and we're coming down a little bit here with the red line. This chart's still clearly negative, but if we continue to see the red line come down and the green line go up, that could end up eventually someday crossing over and being positive, but it hasn't happened yet. We look at the risk on to risk off ratio. When this is going up, folks are getting into Microsoft and Google and Apple and Nvidia. When this is coming down the way it has been, they're getting out of Google, Nvidia, Microsoft, and all those other stocks. Well, we did bounce up a little bit on Friday, but overall we have been declining here, and that's negative. Now, another thing that's negative, we've been seeing the NYSE is probably the best index right now for holding up. It's not doing great, but it's doing better than a lot of the other indexes like the S&P, even the Dow, and the NASDAQ and NASDAQ 100. Well, we measure the NYSE advanced decline line here, and we came down to the 200-day moving average, and so far we've been able to bounce up off of that. Is that going to mean something? Are we going to be able to see this bounce up even more? And that would help the broader market to turn more positive. Now we're still looking negative here, though. When we look at our advanced decline line studies, this is a different moving average than what I was showing earlier. It's based on different time frames. But we have the NYSE common stock, the S&P mid caps and small caps. All of them bounced on Friday, but we're still below the moving average. The one that's holding up the best is the S&P, but we're not quite back up to the moving average yet. McClellan oscillator. This is overall negative. We actually started to get extreme negative, and now we're starting to bounce back up here. But this is negative since we're still below zero. When that's below zero, that feeds into this next chart, the summation index, where we're continuing to decline based on price. We're also continuing to decline based on volume. But if you really look hard, you can see a little bit of an uptick here based on volume. Does that mean something? Are we going to see more follow through? Are we going to see this chart actually turn back and look a little more positive? So right now, if you look at it, it's negative. But if you really hone in on this little dinky part down here, it's giving us a mixed picture that could be turning back a little bit more positive. Then we look at the NYSE McClellan oscillator. It bounced up on Friday, but is still below zero, and we're still declining based on price and volume with the summation index for the NYSE. We're negative with the daily chart of the parabolic SAR. The dots are still on top. And now for 2 weeks in a row, we're negative with the weekly chart of the parabolic SAR. But this is actually not a really bad looking bar here. Notice how we opened and then we came down and set a low at 5,500 and then we closed up off of that. So maybe there's some improvement that could show a little bit more follow through. But for right now, this chart's negative. And on a momentum basis, this is a daily chart, and I have 2 short-term, 3 intermediate-term, and 2 long-term oscillators. All of them are negative. That's the negative side. The positive side is we're getting very low readings with some of these to the point where maybe they are oversold. Maybe they've gone down too far and they're getting ready to turn back up. But we really don't see any signs of that yet. This is a longer term look at another momentum oscillator called the Copic curve. Usually I show a shorter term version of this, but you can see how we're really down. We're negative, but you can see we haven't seen this low of a reading since we've been back here. This was a pretty significant low that we set back in 2022. That's when we were in a bear market. And then even then we were able to bounce up out of that. So since we're getting such a low reading here, maybe we'll get some kind of a bounce. And as I said earlier, if we do bounce in the upcoming week, we're going to be watching for overhead resistance to see, can we break through that resistance and turn back positive, or are we just wearing off some of these extreme negative conditions before we get set to go to turn and go back down even more? The bullish percent index, it did tick up on Friday, but it's still negative and it's below 50. And we look at the NYSE bullish percent index, ticked up a little bit, but it's still negative. And we were extreme negative with the NASDAQ 100 bullish percent index and actually bouncing up a little bit. Can we see more strength out of this? That would be rather encouraging. And then those stocks in the S&P above their 20-day moving averages, we actually got down to an extreme level where less than 20% of all the stocks were above their 20-period moving average. Now, we could go lower than that. We went lower back in December, and then we saw a nice little upward move when we had an extreme negative reading here. But if this can continue to go up, that might really help the short term improve. Then those stocks above their 50-period moving average were negative since we're below 50, but we saw a bit of a bounce on Friday. The 100-period moving average study is negative as well, but a bounce on Friday. And we're below 50 with the 200-day moving average study, but we did see a bounce on Friday. And we've been watching some Fibonacci retracement levels. This goes back to the low that was set in April a year ago to the all-time high, which was set just back in February, and measures Fibonacci retracements here. We had been watching this 61.8% retracement. Well, we broke through that. Now we're holding on to the 50% retracement. That means that we've given back half of the gains that took a year ago until February. Just in a matter of a few weeks, we gave half of those gains back. That just shows you how quickly the market can go down. But so far, we're above this 50% level. We came down, we actually closed below it on Thursday, but we came back above it on Friday. Can this support level hold? And if we do go up, is this next level going to provide overhead resistance? If we break through that, that's going to help things turn more positive. Now, if we break down back below 50, that's going to keep things more negative, and then we could come down to this 38.2% retracement level. And then this is my personal take on why we're having a lot of the trouble that we're having. This is a trend channel going back to 2009. And in early December, we set an all-time high and we hit the upper end of this trend channel. And anytime we've been trying to get above it, we just can't seem to do it. And this was about the time when stocks really started to languish, just kind of meander around and not really show any strength. It's when we were dealing with the upper end of this trend channel, and now we're starting to come back down. And I'm treating this more as negative because we have been declining. And this is something that we don't see very often. This is a long-term oscillator called the special K, just like the cereal. We're dropping below the red line. And the last time we got a signal was in late 2023. And we've been riding a positive signal ever since then with some bumps along the way. Well, this could be long-term negative. But there have been times when we've crossed down negative only to come back over positive again. So it doesn't necessarily mean it's the end of the world, but this is definitely a negative sign. And then we're just waiting to see if this is going to be something. This is the mass index where we generated 2 out of the 3 criteria. When we come down to the red dashed line, that will be the third criteria. And whatever was happening at that point, the mass index thinks it will reverse. So in this case, it might be a reversal to the upside, but we don't have all of these signals fulfilled yet. Another interesting indicator is called the Pring bottom fisher. It got close a couple of times, but if the black line crosses above the red line, that would be a buy signal. But we're not there yet. And now we're also seeing more weakness here with the Dow. It was one of the better looking indexes. Well, it fell below its 200-day moving average this past week. The NASDAQ is below its 200-day moving average, but still holding out above this S2 support level. And the nice thing about these pivot points is we see them ahead of time. So we can watch for these things. We're also dealing with an S2 level with the NASDAQ 100, but still below the 200-day moving average. Small caps looking really bad. They actually dropped below this S2 level, but we're able to get that back on Friday. And we're getting really close here. Now, I follow 2 small cap indexes. The S&P 600, that's getting really close to a death cross here. And that could be quite negative. Then I also follow the Russell 2000 small cap index. This is a little further away, but we could be getting ready for a death cross here as well. The mid caps kind of getting close to that potential death cross here, but they've been really weak lately. But they were able to get back above this S2 level in Friday's session. Now, looking at our growth to value ratios, we're not seeing really any improvement there. We look at the small cap growth to value still below its 200-day moving average, even though this is in a defined uptrend. Mid caps also still below their 200-day moving average with the growth to value ratio, and still below the 200-day moving average with the S&P growth to value ratio. So not much of an improvement that way. Not much of an improvement here. We take a growth ETF and a value ETF and do a ratio. We're still below the rainbow. And then we look at discretionary versus staples. A little bit of a bounce here, but still dealing with its 200-day moving average, where this had been one of the stronger performing areas going back to last summer into late 2024. We're below the 200-day moving average with large cap growth. We need to get that back. We're starting to see some shorter term moving averages cross below a little bit longer term moving averages. That's turning things more negative. And we look at our growth to value ratios, all negative right now. The Qs to S&P down. Discretionary to S&P down. Large cap growth to large cap value down. And all of these moving averages are declining. And we're declining when we look at the large caps, mid caps, and small caps. And then this has been going up here. This is staples, that's defensive, versus tech, that's growth. When this is going up, that means staples are outperforming. Well, we've been coming down a little bit here. If this could continue to fall, that could turn things more positive. If we keep going up, we're seeing what could be a cross here where we've seen staples really underperforming tech for a long time. Are we starting to see that shift over? This would mean that the market's becoming more defensive. That same basic idea, when we look at staples to the S&P index itself, it's really been going up. That means things are getting more defensive, but lately it's been coming down. If this can continue to go down, that might be more positive. S&P to utilities, that when we're going down, that means the S&P has been underperforming utilities. We haven't seen an awful lot of conviction in here, but if this continues to fall, that will be negative. If it can turn and go back up, that would be more positive. And we're underneath the 200-day moving average with the Wilshire 5000. This is a broad market measure. And the total US stock ETF also still below its 200-day moving average. Financial sector is still looking more positive. Hasn't come down to its 200-day moving average yet, but it's been getting hit like everything else. And we want to keep an eye on this. We also keep an eye on the bank ETF, which is now below its 200-day moving average. And we want to keep an eye on the regional banks. These are the smaller banks. It's also under its 200-day moving average. And we look at a ratio between the regional banks and the financial sector. And even though the financial sector has been getting hit, regional banks have been getting hit even more. And that's why we're seeing this ratio going down. And this ratio is actually turning negative. So this is not looking really good right now. It needs to see some pretty intense buying to turn back and look more positive. The FANG index, which fell below its 200-day moving average, came right back up and closed a little bit above its 200-day moving average. These are the really big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia, and a bunch of other ones. These are the ones that really drive the market. And this is what's been really pushing the market down, is these stocks have been under a lot of weakness. If we can hold on to this 200-day moving average and go back up, that would help turn things more positive. But we don't know that yet. So for the time being, we have to treat this as negative. And we look at the tech sector, which is underneath its 200-day moving average. The longer we stay under here, we might see a death cross with this. And here's another look at the tech sector. We're well below this rainbow. That's negative. And the SOX, semiconductors, which are a huge part of tech, they've been in a downtrend going back to last fall. And now even seeing more weakness. We need to see the semiconductors do well if we're going to help see the market help to turn back more positive. But right now, it's not looking all that good. And the Dow Jones semiconductors, they are still in an uptrend, but they're below both of these moving averages, and we might be getting ready to see a death cross here. The SMH semiconductor ETF, below the moving average and just generating a death cross this way. And we're below the rainbow when we look at that same ETF, and we're seeing some real weakness here. So the market has to do some heavy duty buying to really turn things back more positive. And we look at the semis to tech ratio. When the market's really positive, this ratio will go up. That means the semiconductors are outperforming the tech sector. Well, last summer, we saw a real reversal go on here where the semis started to underperform the tech sector. We were still setting new all-time highs with this ratio going down, but then we kind of bottomed here and we've been chopping. There's a little bit of an up move, a little bit of a down move, but it's not really showing an awful lot of conviction right now. Then the robotics and AI ETF, that's where everything's at these days is AI, and a lot of companies are talking about it. It's the new rage. We're below the rainbow here with this ETF. And another AI and tech ETF, we're dealing with the 200-day moving average. And this is still in an uptrend for right now. Can this hold and bounce up out of that, or are we going to drop down below it? And you'll notice right about when AI became the big rage, look at the volume increase in this ETF. And then we look at a ratio between stocks and bonds. When we're above the rainbow, that means the market is anticipating a soft landing, no recession. Now that's being questioned. We're coming down below the rainbow, and if we continue to go down, we might actually have the market anticipating a hard landing, which means we will go into a recession, or at least the market thinks that. And we're seeing a real shift here for a long time, going back to 2023. Bonds have been underperforming stocks. Lately, we're seeing a reversal of that. This is an inverse of that chart I just got done showing you, only it's bonds first instead of stocks first. Then you're going to see a lot of the same things here. When we look at stocks versus bonds, pretty much all of these are below the rainbow. This is the S&P 1500, a broad market measure, below the rainbow. Another broad market measure, 3 to 7 year bonds, below the rainbow. Tech sector to 3 to 7 year bonds, below the rainbow. Home construction to 3 to 7 year bonds, it's been below the rainbow for a while and is actually showing more weakness. The QQQs to 3 to 7 year bonds, below the rainbow. Now you see we bounced up a little bit on Friday. Is that the beginning of something or just a pit stop before we get set to go even lower? And then we are looking more negative here with the weekly chart of the NASDAQ. This is a trend line going back to 2009. We broke below that a week or so back. And so when we're below this trend line, that's treated as more negative. And then we look at the broad market, and then we take a 5 period moving average of the highs and the lows. We're below zero. That's showing internal weakness right now in the market. And we look at the S&P a little bit longer term, a 10 period moving average of the highs and lows just in the S&P. This is below 50 and declining. So that's negative as well. We look at a ratio between the semiconductors and the Dow, and both have been getting beat up pretty hard, but semiconductors have been going down even more. So this ratio is going down. And I have this on the negative side because interest rates have been coming down, but lately they've been going back up. So that tends to be more negative for stocks. Then we have this thing called the Hindenburg Omen. And if you've never heard of that before, this is, oh, just pause this and read all this stuff over on the side here. And it gives you the 3 criteria to meet for a Hindenburg Omen. And you can just tell by the name, the Hindenburg, the humanity and everything. It's a negative thing. Now, back on March 3rd, we saw a spike up here. What stockcharts.com does is they put all 3 criteria into one chart. And we have not seen a confirmation though. We saw the initial spike, and between now and March 31st, we need to see another spike. That would be a confirmed Hindenburg omen, but we're not getting that yet. Then here's some areas that I'm watching. We want to keep an eye on jobless claims, which actually have been going down. That shows economic strength, not weakness. And that's the part of the economy that I've been really watching now. Folks are worried about inflation, but you're going to see here in a while the market doesn't seem to be all that worried about it right now. And the other area is how's the job market doing? This actually shows that fewer people are claiming unemployment. Fewer people are getting laid off. That means economic strength, not weakness. Now, off into the future, we're going to start seeing all these federal job cuts. They're going to start coming in to this reading here, and that could really shoot this up higher. But we're not seeing that yet. And then we look at continuing claims, which are in a trend higher, but they really came down this past week. They've really been going kind of sideways lately. Again, if all these job cuts in the federal government really start to kick in and come into the data, we're probably going to see this go up. And then this just puts everything together. The red line are the initial claims, the blue line are continuing claims. And then a week ago, we had the recent unemployment rate, which was at 4.1%. And then this is an interesting thing too. We look at a weekly chart of the S&P and a weekly chart of the German DAX, and that's the biggest stock market in the EU and also the biggest economy. You see how the S&P has been coming down, but the DAX has just been going to the moon. And enough so that they're getting out of sync with each other, and that's really bringing our correlation back down to neutral. Where for the most part, they tend to have a pretty high correlation. If Europe's going up or down, America's going up or down, and vice versa. We're not seeing that right now. Then, looking at the relationship of different bonds, this is what I talk about. Where if you look at cash to 1 to 3 year bonds, this is actually coming down. When this goes up, that means folks they're fearful of inflation and interest rates going back up. And we were doing that in late 2024, but lately we've been starting to come back down. Then we look at tips, which adjust for inflation and interest rates. When people prefer those, this ratio goes up, and that means they're concerned about inflation. And we were doing that at the beginning of 2025, but then we topped out. Now we're starting to come back down here when we compare it to 3 to 7 year bonds. Then we look at tips to 7 to 10 year bonds. They were really shooting up, now starting to come back down. Then another thing that we're keeping an eye on is most people follow the 10 to the 2 year yield curve, and that's still looking normal as you can get these days. But if you look at the 10 to the 3 month yield curve, which not as many people focus on, we've gone inverted again here. We're into this red area, and this signals economic, at least concern off into the future. But we went for a couple of years and we were inverted with this yield curve, and then we finally went back to normal, and we didn't go into a recession, at least yet. Now we're coming back down into this. Once we come out of here, then that usually starts some kind of a countdown to see if we're going to go into a recession. And we want to keep an eye on oil, but it's actually been going down. And then here's another ratio showing the US market as measured by the S&P and the German market. You can see here how when this is going down, that means US stocks are really underperforming. But then we also want to keep an eye on the 10 year yield in Germany because it's really going up. Now, there's some speculation that the reason why this 10 year yield's going up is because, well, maybe it's going to be Europe that helps Ukraine out between Russia and Ukraine. And so we're seeing interest rates going up because of that possibility, but we're also seeing the stock market going up at the same time. So we want to see if this is going to keep going up because sometimes what happens in Europe happens before it happens in the US. So that's why I keep an eye on the European markets. Then we want to keep an eye on the dollar, which had been doing really well. This is when all the tariffs, and the dollar likes tariffs. That means protection. That means the dollar is going to be worth more. But lately, it's just been getting hammered. We went from the 107 range all the way down to the 103 range now. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.